Today, we're delving into the perplexing world of the Federal Reserve and its apparent struggle to maintain control over the markets. Something's afoot, and we're about to dissect the why, how, and what it means for you. In the intricate dance of economic policy, December 13th marked a significant moment as the Federal Reserve unveiled its anticipation of rate cuts in the near future. The face of the Fed, Jerome Powell, took center stage, boldly asserting that the prevailing interest rates were probably at their zenith. Powell's forward-looking stance was crystal clear. He foresaw 3 rate cuts on the horizon in the coming year. This announcement set the stage for what seemed like a strategic maneuver to navigate economic challenges and perhaps inject some flexibility into monetary policy. However, the script took an unexpected turn merely 2 days later. Panic rumbled through the financial world as John Williams, a notable figure within the Fed, backtracked on the anticipated rate cuts. Williams, in a bid to manage the narrative, emphasized that the central bank was not currently in discussions about reducing interest rates. Instead, he redirected the focus towards assessing the overall restrictiveness of the monetary policy in place. This sudden about-face left market participants and observers perplexed, questioning the Fed's coherence and signaling a potential internal divide. The divergence between Powell's forward-looking optimism and Williams's more cautious tone underscored the challenges faced by the Federal Reserve in communicating a unified strategy. The market, always sensitive to the nuanced language of central bankers, reacted swiftly to this seemingly conflicting information. The episode revealed not only the intricacies of monetary policy, but also the delicate balancing act required to provide guidance without causing unnecessary turbulence in the financial waters. As we unravel the Fed's communication strategy, it becomes evident that navigating the economic landscape is akin to interpreting a multifaceted puzzle, one where each piece holds the potential to shape the future trajectory of markets and economies. Let's delve into the Federal Reserve's toolkit, where the linchpin is the interest rates, particularly the federal funds effective rate, currently standing at 5.33%. This rate is the bedrock of short-term lending among banks, occurring overnight. What makes it crucial is that it is directly controlled by the Federal Reserve, which endeavors to maintain it within a specific and narrow range. This level of control over the federal funds effective rate allows the Fed to influence short-term borrowing costs among banks, providing a tool for regulating the overall money supply and liquidity in the financial system. However, it's imperative to recognize a crucial nuance. The federal funds effective rate primarily affects overnight cash needs within the banking system. In other words, it's a mechanism for banks to manage their daily liquidity requirements. Herein lies the twist. Despite its significance in the financial realm, this rate does not have a direct impact on interest rates that most individuals encounter in their daily lives, such as credit card or mortgage rates. The federal funds rate operates at the shortest end of the lending spectrum, focusing on the immediate and brief borrowing needs of financial institutions. To understand this distinction further, imagine the federal funds rate as a tool that allows banks to meet their overnight cash needs effectively. It's like a backstage mechanism for the financial institutions to ensure they have the necessary funds for daily operations. While this may seem distant from the average person's financial concerns, it plays a pivotal role in shaping the broader economic landscape. The Federal Reserve's ability to fine-tune this rate reflects its overarching goal of maintaining stability and control within the financial system, with repercussions that ripple through various sectors of the economy. Enter the reverse repurchase facility, a component of the Federal Reserve's toolkit that mirrors the workings of the repo market. In essence, this facility serves as a strategic mechanism through which the Fed pays banks to refrain from injecting cash into the broader financial system. It's a bit like a financial maneuver to keep excess cash out of circulation. This tool is particularly crucial when the financial system is inundated with liquidity, and the Fed needs to manage the level of cash flowing through the markets. Now, the intriguing part is how the Federal Reserve is deftly juggling these various tools trying to strike a delicate balance in the intricate dance of monetary policy. The reverse repurchase facility, while akin to the repo market, plays a distinctive role. It's a way for the Fed to regulate the supply of money circulating overnight, acting as a counterbalance to its other tools, such as the federal funds effective rate. However, amid this intricate dance of financial instruments, a concern arises, one that resonates with everyday individuals. The Federal Reserve's influence is potent within the intricate financial plumbing, but it doesn't wield a direct hand over interest rates that hit close to home, such as those affecting mortgages. The reverse repurchase facility, much like the federal funds rate, operates at the shortest end of the lending spectrum, addressing immediate cash needs among financial institutions. This distinction underscores the complexity of the Federal Reserve's role. While it can exert significant control over the inner workings of the financial system, its impact on interest rates that matter to individuals like mortgage rates is more indirect. This separation between the tools the Fed employs and the interest rates affecting consumers emphasizes the multifaceted nature of monetary policy and how its intricacies may not always align with the immediate concerns of the general public. As we navigate the economic landscape, understanding these subtleties becomes paramount to deciphering the broader implications for individuals and households. Their other tool, the balance sheet. When it grows, it injects cash into the economy by buying assets, affecting long-term interest rates. In 2015, it hit $4.20 trillion. But hang on, they're also doing quantitative tightening when it shrinks, affecting long-term rates by letting treasuries mature without replacement. The impending chaos in the economic landscape stems from the Federal Reserve's intricate dance with seemingly contradictory strategies. On one hand, the Fed signals its intention to implement rate cuts, a move designed to stimulate the economy and ease borrowing costs. Yet, on the other hand, there's a steadfast commitment to quantitative tightening, a strategy involving the reduction of the balance sheet. The confusion arises as these two actions, seemingly at odds, coexist in the Fed's playbook. While short-term interest rates may experience a decline as a result of the planned rate cuts, the simultaneous reduction of the balance sheet introduces the potential for long-term rates to rise. This intricate interplay reflects the delicate balancing act the Federal Reserve faces, attempting to navigate economic uncertainties while managing the repercussions of its diverse toolkit, leaving both investors and the general public grappling with the complexity of the forthcoming economic landscape. In the intricate web of monetary policy, the complexity deepens with the reverse repo facility taking center stage. This facility, designed to absorb excess cash from the financial system, is now in a draining phase. In simpler terms, the reverse repo facility is experiencing a substantial decrease in the amount of cash it holds. This seemingly technical adjustment carries profound implications, particularly for short-term borrowing. As the reverse repo facility drains, less cash is available for short-term borrowing needs in the financial markets. Picture it as a reservoir slowly depleting, and the ramifications could be felt in the form of potential spikes in short-term interest rates. This phenomenon has the potential to send ripples through various aspects of the economy, creating a domino effect that extends into the fabric of everyday life. Bracing for this impact becomes crucial as it signals a series of potential disruptions. The first in line is the ominous prospect of a recession. Spikes in short-term interest rates can tighten financial conditions, making borrowing more expensive for businesses and consumers alike. This, coupled with other economic uncertainties, may trigger an economic downturn. And if you thought that was all, buckle up. The Fed might pull out Operation Twist or even Treasury buybacks, where they buy their debt back to keep things afloat. Expect the unexpected. We're in for economic shenanigans. Whether you're an investor or just trying to navigate your financial boat, understanding these market intricacies is key. Stay informed, stay prepared. This is the economic roller coaster you didn't sign up for, but it's the ride we're all on. As always, thanks for tuning in. Have a great day, and may your portfolios weather the storm.